Picture this. It is 2 in the afternoon. Silver just broke $80 on what looks like one of the biggest green candles of the entire year. Your phone is buzzing. Your notifications are going off. Every financial headline is screaming once-in-a-generation breakout. And you feel it. That electric pull in your chest telling you to get in right now, because if you miss this move, you will regret it for the rest of your life. So you buy. Full size. Right there at the peak of that candle, and then the market pulls back. It always pulls back. But now you are already underwater. The position feels wrong the moment you enter it. Your palms are sweating. You are refreshing the chart every 30 seconds. And eventually you do what most people do in that moment. You sell. You lock in the loss. You tell yourself you will wait for a better entry. And then 3 weeks later you watch silver quietly building higher from exactly the level you panic sold. And it never stops going up. That story is not hypothetical. That sequence plays out for thousands of people at virtually every major breakout in every market that has ever existed. And today, I'm going to make absolutely sure it does not happen to you. My name is John A.G., and what I am handing you in this video is not a price prediction. I am not going to tell you silver is going to 120, and I am not going to tell you this breakout is guaranteed to fail. What I am going to give you is a professional framework, sharp enough, precise enough, that by the time you finish watching, you will be able to open a chart on any morning, run 2 simple questions in under 5 minutes, and know with structural clarity whether what is happening at $80 is a genuine regime change or a trap built specifically to harvest your money before reversing hard. Stay with me through the middle of this video. That is where the 2-step truth test lives. That test alone is arguably worth more than the vast majority of the silver content circulating right now. But to understand why those 2 steps work the way they do, you first need to understand something about $80 itself, something most people completely skip. And it is the foundation that makes everything else click into place. Markets are built by human beings, and human beings anchor to round numbers the way ships anchor to docks. They set their stop-loss orders at round numbers. They place their take-profit targets at round numbers. Their risk management systems trigger automatically at clean, visible, whole numbers. Their algorithms are literally coded to respond at those levels. Every participant in the silver market, the pension fund manager in London, the hedge fund running systematic strategies, the dealer managing option exposure, the retail trader sitting in their bedroom at midnight, every single one of them has $80 marked somewhere on their mental map. And here's what that means in practice. Every time silver approaches 80 and pulls back, every rejection, every test, every fade, each one of those interactions compresses decisions into tighter and tighter space. It compresses stop placement. It compresses positioning. It compresses risk. Think of it exactly like a coil spring being forced down with increasing pressure. Each rejection adds energy to the coil. Each test loads more tension into the structure. And the longer that spring is compressed, the more explosive the release when it finally comes. That release will happen. The only question, and it is the one that determines everything, is which direction it releases. Hold on to that phrase, which direction, because most people stop thinking carefully right there. They see a big round number breaking and they assume price goes up forever. I want to show you precisely why that assumption is arguably the most expensive mistake you can make at a moment like this. And more importantly, I want to give you the exact conditions that tell you which direction is real before you have a dollar at risk. But before the conditions, I need to give you something that will permanently change how you read these moves. Something I call the difference between a breakout and acceptance. Most traders use those 2 words interchangeably. They are not the same thing. And that distinction is where the money actually lives, not in the excitement of the candle, but in what happens after. A breakout is an event. It is a candle. It is a moment in time. It can be produced entirely by mechanical stop running with zero genuine buyer interest behind it. Some of the most violent green candles ever printed in any market were, in hindsight, fake. They were stop hunts. They were the result of larger players triggering the exact feeling I described at the open. The urgency, the fear of being left behind, the explosive move that makes you feel like you are already too late. The breakout candle might be real. It might be a trap. At the moment it is forming, you cannot know which one it is. Nobody can. Anyone who tells you they can is selling you something. Acceptance is something entirely different. Acceptance is when the market closes above a level, pulls back to test it from above, and holds. It is when buyers who were not involved before start defending the zone without needing a headline to give them permission. It is when what was previously resistance becomes support in the actual observable behavior of the tape, not in a tweet, not in a YouTube comment section, but in real sequential price action across multiple sessions. Write this down if you have a pen. The breakout is the headline. Acceptance is the verdict. The headline gets written while the battle is still happening. The verdict only arrives after the dust settles. Traders who wait for the verdict survive this kind of move. Traders who react to the headline become the story profitable traders tell about how they cleaned up that week. Now I want to tell you something uncomfortable, something most content in this space is too careful to say directly. At major visible levels, the market will sometimes deliberately look like it is failing right before it actually succeeds. Not because of a conspiracy, not because someone in a room is pulling a lever designed to hurt you personally, but because confusion at key levels is precisely where the most liquidity is collected. Before a genuine breakout develops into something sustained, you can get a fake flush below the level that sweeps every obvious stop before the real move begins. You can get shakeouts so violent they feel exactly like full reversals. You can get 3, 4, even 5 days of grinding, exhausting chop that wears down both the bulls and the bears before the market finally resolves cleanly in one direction. This is not theory. Think about every major breakout you have ever studied on a historical chart. Every one of those moves looks clean, obvious, and inevitable in hindsight, but it looked terrifying while it was happening. The discomfort during the move is not a bug in the system, it is a feature. The move needs to feel uncertain, genuinely uncertain, to keep most participants sidelined or positioned on the wrong side, because if it felt obvious, everyone would already be long. All the stops that fuel the short squeeze would already be gone. And there would be no trapped energy left to power the cascade that defines the rare large move. Which brings me to what I want to spend real time on, because understanding this one mechanism is what separates analysts from actual participants. I am talking about what creates a generational move from the inside, not the polished post-mortem you read months later, but the raw mechanical reality of how these things unfold in real time when you are watching the tape live. A generational move is not born from optimism. It is not born because analysts agree the trade makes sense, or because a spreadsheet says fair value is higher. Generational moves are born from forced behavior at scale. Let me walk you through the sequence as it typically unfolds. Silver is sitting near 80 with what appears to be heavy short positioning. The big, visible, round number has attracted everyone who wants to fade this market, because every time before the level held and shorts were rewarded, they feel validated. Their thesis has been proven repeatedly. They are sleeping soundly. And then the level breaks cleanly. The moment it breaks with commitment, multiple things tend to happen simultaneously, and they compound each other like accelerants in a fire. Shorts that are suddenly wrong get squeezed. They have to cover. Not because their view changed, not because they now believe silver is worth $100, but because their broker says so and their margin account says now. That is forced buying that has absolutely nothing to do with anyone's opinion about fundamental value. Simultaneously, dealers who sold options against key strike prices may need to hedge their exposure by buying the underlying asset. More forced buying. Momentum systems that were configured to wait for exactly this kind of signal can fire automatically, and the cascade begins to build on itself. Suddenly there is a wave of orders that nobody chose to place based on what they think silver is worth. They are mechanically obligated. Nobody is delighted to be buying at this price. They are buying because the structure of their positions demands it. That is how you can get silver up several dollars in a single hour with no news catalyst that adequately explains the move. The news did not create it. The positioning structure created it. The news arrived afterward and gave people a narrative to attach to something that was already happening. And here is the critical part, that cascade can drive price far beyond what any fundamental model would justify, and it can do it faster than feels rational from the outside. This is exactly why chasing at the peak of the cascade is so expensive. When you buy the spike, you are buying after the forced sellers have already been wiped out. You are buying at the precise moment when the only people left buying are the ones who just discovered the move and have no plan. And when the cascade exhausts itself, because it always exhausts, there is nobody left to take price higher. The air pocket below you can be deep, and the fallback can be fast. Now we are ready for the two-step truth test. I want you to actually run these 2 questions, not just hear them, not just nod at them, but apply them every single morning before you touch this trade. Question 1. Where did price close on the daily chart? Not the intraday high, not the spike, not the wick that got everyone excited at 2 in the afternoon. The daily close. The daily close is the referee of every session. Intraday moves show you the battle. The daily close shows you who won. A close above 80 means buyers held their conviction through the full session. They were willing to still be holding silver when the books closed for the day. A close below 80 means sellers were ultimately in control when the session was settled, regardless of whatever happened on an intraday basis. The daily close is arguably the most important number for determining who controls the level. Question 2. What happened at the first meaningful test of 80 after the initial move? After price crossed above, did buyers come back and defend the level without needing a catalyst to justify the bounce? Did the market slow as it approached 80 from above and then recover organically? Or did price slice right back through the level as though it meant nothing, And when buyers tried to push it back above, did they immediately find sellers waiting for them? Those two questions contain everything. Above and holding suggests acceptance is building. Below and failing suggests rejection is building. That is your entire morning checklist. 30 seconds with a coffee in your hand. You are not spending an hour reading 12 indicators that are all telling you 12 different things. You are asking the two questions that cut cleanly through all of it. Now let me build on those two questions with 5 specific conditions I want you to know before this trade develops further, because knowing your conditions in advance means you are never making decisions in real time based on how a candle looks emotionally in the moment. You are checking reality against a standard you established before the market opened. That discipline alone will protect you from the two behaviors that destroy more accounts in fast-moving markets than almost anything else. I will name those behaviors before this video ends, and when I do, I think you will recognize yourself in at least one of them. The first confirmation condition, silver closes above $80 on the daily chart. This is the first gate. It is necessary, it is not sufficient by itself. One daily close above 80 does not confirm a regime change. It opens the conversation. Without it, you are speculating about a level that has not been claimed. The daily close above 80 is the first piece of evidence you need before anything else matters. The second confirmation condition, the first pullback holds. Whether price pulls back toward 80 and finds buyers before it even touches the level, or it taps 80 from above and bounces, the observation you need to make is this. Does the market slow down and recover without a news catalyst making it happen? A bounce that requires a headline to develop is significantly weaker than a bounce that finds support on its own. You want to see 80 treated as a floor on the market's own terms, because organic defense tends to be real defense. Headline-dependent defense is often temporary and unreliable. The third confirmation condition, structure builds over subsequent sessions. The swing lows on the daily chart stop making lower lows. A staircase begins to form. Each pullback finds support at a higher price than the one before it. The tape shifts from sideways chop to a clear sequence of higher swing lows across multiple sessions. That structural shift is the confirmation that the move has genuine depth, not just the mechanical momentum from a single forced buying cascade, but sustained interest from buyers who are choosing to own this market at progressively higher levels. Those are your 3 green lights. Now the 2 red ones. Break condition 1, a daily close back below 80 after having previously closed above it. Not an intraday dip that recovers by the close, a full session close below the level. When this happens, it is the first serious warning that acceptance may not be building the way it needs to. It might still be a shakeout. Markets absolutely do flush stops below major levels before continuing higher, and this can happen more frequently than most people expect. But you cannot ignore a full daily close below 80. It demands that you stop, reassess, and watch what happens next before adding any exposure. A shakeout followed by immediate recovery above the level within the next session is one thing. A close below 80 that leads to sideways drift below it is something else entirely. Break condition 2, a failed reclaim attempt. Price is trading below 80. Buyers push it back toward the level. The rally fails immediately and hard. Sellers are actively defending 80 from above. The level that was supposed to be new support has functionally flipped to active resistance. When this failure follows a close below 80, the two conditions together are not ambiguous. That is not a shakeout. That is rejection being confirmed session by session. That is the market telling you the breakout did not hold, and the right response is not hope. It is to step back and wait for the next genuine setup. 5 conditions. 3 green, 2 red. That is the entire decision tree. You do not need 17 overlapping indicators all giving you conflicting signals and creating an environment where you can rationalize whatever you already want to do. You need closes, holds, structural higher lows, and the 2 failure signals. Simplicity here is not a shortcut. It is precision. Every condition you add beyond these 5 introduces noise that gives you more opportunities to rationalize the decision you should actually be reconsidering. Now let me give you 30 seconds on the macro environment, because silver does not trade in isolation, and reading price action without reading the surrounding conditions is like navigating with a compass while ignoring which way the wind is blowing. 3 external gauges can tell you whether the environment is cooperating with a metal's breakout or pushing against it. The US dollar index is the first. A surging dollar historically creates a headwind for metals globally, because silver is priced in dollars everywhere. A weakening dollar tends to remove that headwind and give the breakout room to develop. You do not need to predict where the dollar goes next. You just need to know whether it is accelerating higher or rolling over. That direction is your wind reading. The second is the 10-year Treasury yield. Rising yields in a rising dollar environment can signal tightening financial conditions, and metals with no yield attached have historically tended to struggle in those conditions. When both the dollar and the 10-year are stable or declining, That is often the environment where metals find their best runs, though past patterns are never guarantees of future behavior. The third, and arguably the most precise of the three, is real yields, specifically the 10-year TIPS yield, which represents the nominal rate adjusted for inflation expectations. When real yields fall, the cost of holding a non-yielding asset like silver tends to drop, and the opportunity cost argument against owning it weakens. The relationship between falling real yields and silver price strength is one of the more consistent macro correlations analysts have observed across decades of data, though correlations can and do break down. When real yields are rising sharply, your confirmation conditions arguably need to be met with even cleaner evidence before you build size, because the breakout may be working against a genuine headwind. Here's the important nuance, though. Silver is a hybrid market. It carries monetary characteristics and it carries significant industrial demand, which means silver-specific forced flows can sometimes overpower a moderate macro headwind. But if all three gauges are simultaneously moving against the breakout with real momentum, you may want more clean tape evidence before you commit meaningful capital. The macro does not override what price is doing, but dismissing extreme macro pressure because you like the silver story has historically been expensive. Now I want to talk about what this actually feels like from the inside while it is happening, because this might be the most important thing I say in this entire video, and it is the thing that most frameworks leave out entirely. Most people imagine that a genuine generational breakout, if it is real, will eventually reach a point of obvious clarity. A moment where everything lines up, the headlines all agree, and the move becomes undeniable. That moment almost never arrives while the move is still in progress. Real moves feel genuinely uncertain while they are happening. Every pullback during a real uptrend feels like the thesis is broken. Every shakeout feels like a full reversal. Every day of consolidation feels like the fuel has run out. You look at the chart months later, and the move looks smooth and inevitable. But that smoothness is the lie that hindsight tells. The move has to feel uncertain while it is developing, because if it felt certain, the capital sitting on the sidelines would already be long. The forced buying cascade would have nothing left to harvest, and the rare sustained move never develops in the first place. You are not trading certainty. You are trading three confirmation conditions building in sequence. When all three are present, you are not certain the move continues. You are simply positioned on the side that has the most structural evidence. That is the professional posture. Not certainty, evidence. Now the two behaviors. I told you I would name them, and I told you you would recognize yourself in at least one. Here they are, said plainly, because the polite version does not actually help anyone. The first is chasing. Chasing is when you see the large candle, feel the urgency of the moment, and buy at the most emotionally charged point, the very peak of the spike. The market then does what every real breakout typically requires. It tests, it breathes, it pulls back. But because your entry was at the top of the most aggressive candle, you are immediately underwater. The position feels wrong from the first minute. Your brain starts hunting for reasons to exit. You sell the pullback, book the loss, and watch the move continue higher without you. That is not bad luck. That is entry timing, driven entirely by the fear of missing out, and it is completely avoidable if you wait for the conditions instead of reacting to the candle that creates the emotional charge. The second behavior is forcing. Forcing is what happens when you are so committed to a thesis, so emotionally invested in being right about this specific trade, that when the market pulls back and challenges your position, instead of reassessing, you add to it. You average into a move that might be failing. You tell yourself the market is wrong and you are right, and you prove your conviction by doubling your exposure. In a market as volatile as silver, which can move several percent in a single session even inside a healthy trend, that mindset can end accounts. The market does not care about your thesis. It only prints the tape. Here is the rule that cuts both behaviors off before they start. If the headline makes you feel like you should size up immediately, consider sizing down instead. Your emotional intensity at any given moment may be inversely correlated with the clarity of your thinking. The higher the urgency you feel, the smaller the position you might want to take until the conditions confirm. Volatility is a tax on every emotional decision. If your position size does not account for silver's natural breathing room, you can be shaken out of a correct trade before it has time to prove itself. You can be right about the direction and still lose money. That is arguably the most painful way to be right that trading offers. The professional approach after a major breakout gives you exactly two paths, and you choose based on your own style. The first path, do not be in the trade yet. Watch the initial spike with genuine discipline. Let the first pullback establish itself. Observe whether the decline is slowing, whether organic buyers are appearing, whether the level is holding without requiring a catalyst. If those signs are present, that pullback is your entry, and you have a clean invalidation point just below the level you just watched hold. That is a trade with structure. You entered after the evidence arrived, not before it. The second path, Be in the trade with a smaller than normal position during the initial breakout, acknowledging that you are accepting more uncertainty in exchange for earlier participation, and then add to the position only as each confirmation condition is met. Close above 80, add a small increment. Pullback holds organically, add a bit more. Higher lows forming across multiple sessions, scale toward your full intended size. You never reach maximum exposure because a headline told you this is the moment. You scale in only as the tape earns each additional piece of your capital. There is a specific moment in this sequence that deserves its own focus, because it is where some of the most expensive mistakes get made, not just by beginners, but by experienced traders who absolutely know better. I am talking about the retest. After any genuine breakout, there is often a retest of the broken level. This is typically a feature of how real breakouts work, not evidence that the breakout is failing. The retest is the market asking a necessary question. Are the buyers who pushed price above 80 actually committed to defending it? Or were they the mechanical result of a stop-run cascade that exhausted itself the moment the shorts were squeezed out? The answer to that question tends to define the next several weeks of price action. A healthy retest has a recognizable character. Price moves back toward 80. The pace of the decline begins to slow as it approaches the zone. You see selling being absorbed without a catalyst appearing to rescue the market. The bounce begins before price even reaches the level, or it taps it with minimal penetration and recovers quickly. The whole interaction feels like a door being tested from the outside, sellers pushing on it and finding that it holds because genuine buyers are on the other side. The level is acting like new ground that the market has accepted, not like old territory being contested. An unhealthy retest looks completely different. Price moves back toward 80 and cuts through it as though the level never existed. Buyers attempt to push it back above and immediately find sellers waiting. The market begins spending more time below 80 than above it. Sessions start closing below the level. The excitement of the breakout candle starts to look like the exception rather than the rule, and the rule is becoming something you do not want to own. That is not a healthy retest. That is rejection building with each session. And the right response is not to hope the next candle saves you. It is to update your read. And that word, update, is the one I want you to carry out of this video above everything else. Not predict, not wish, not hold on and hope. Update. The market prints truth every single session, and your job is to read what it prints with honesty, without the distortion of your existing position or your emotional investment in being right. When the evidence says yes, you respect the move and stay positioned. When the evidence says no, you step back and wait. That cycle, read, update, act, update again, is the entire profession stripped of every layer of complexity that has no actual value. Let me give you the exact routine for tomorrow morning, because I do not want you leaving this video with a better framework only in the abstract. I want you to have something specific and executable. Open your chart. Mark $80 not as a single precise line, but as a band of approximately 20 to 30 cents on either side, because the market almost never honors an exact number, and building in that small buffer can prevent you from getting shaken out by noise right at the level. Mark any zone below 80 where price has reacted at least twice recently. These are your structural reference points on the downside if the breakout ultimately fails. Then check where yesterday's daily close landed. If it closed above 80, your job today is to watch for the first pullback and apply truth test question 2. Is the defense organic? Does the decline slow as it approaches the level? Do buyers appear without a catalyst? If it closed below 80, your job is to watch the first reclaim attempt and apply the same question in reverse. Does the push above 80 immediately find sellers, or does price hold and breathe above the level once it gets there? Note what you observe. Write it down, not as a spiritual practice, but because writing forces you to commit to a reading before the next candle changes the picture. Traders who do not write their observations can be dangerously vulnerable to revising their memory of what the tape said in order to justify whatever decision they made after the fact. Writing creates accountability to the analysis you actually did, rather than the analysis you later wished you had done. That routine takes roughly 5 minutes. Those 5 minutes applied consistently every morning are arguably worth more than any amount of time spent reading price targets and analyst upgrades from people who are not watching the same tape you are. Let me also give you the framework for thinking about levels in both directions, because you need reference points above and below 80 before the trade moves, not scrambling to find them after it already has. On the upside, if silver accepts above 80 and structure starts building, mark the most recent significant pivot highs, and the upper boundaries of prior consolidation ranges above current price. Treat them as zones, not as precise lines, and treat them as places where selling pressure is likely to increase. Those are where prior sellers feel vindicated. Those are where shorts may try again. Marking them in advance means you already have a plan when a rally stalls at one of those zones. You are not surprised by resistance. You anticipated it. On the downside, if 80 fails, use the same logic in reverse. Mark the most significant swing lows below 80. Mark the lower boundaries of prior consolidation structures. Those zones are where buyers previously showed up with enough conviction to stop the decline. When a level breaks, markets rarely fall in a straight line. They tend to move toward the next visible pocket of demand, react there, and then tell you whether that zone holds or also breaks. Having those zones marked before price reaches them means you are always reading the next piece of evidence rather than chasing the most recent candle in panic. Now the last thing, and it might be the most human thing in this entire video. Understanding a framework and actually executing it under pressure are two completely different skills. You can recite the 5 conditions perfectly right now and still buy the spike in a panic the next time silver makes a move like this. Because the moment the large candle is printing and the notifications are firing and every platform is screaming this is the moment, something physiological happens. Something that temporarily makes your rational mind less powerful than your emotional one. That is not weakness. That is not a character flaw. That is biology. It happens to experienced traders. It happens to people who have been doing this for 20 years. It happens to everyone. The only protection against it is rules that were established before the tape accelerated. Rules that do not bend because of how you feel in the moment. Rules that are already written down, already committed to, already non-negotiable before the move begins. Your rule is the daily close. Your rule is the behavior of the first pullback. Your rule is higher lows building across multiple sessions. As long as you answer those questions with discipline and complete honesty, the natural chaos of a fast-moving market cannot compromise your process, even when it is doing everything in its power to make you feel like you must act immediately or be left behind forever. The close above 80 is the first gate. The pullback hold is the real signal. The structural higher lows confirm the depth of the move. All 3 together suggest the regime may be shifting. Any 2 of those failing tells you the trade needs to be reassessed rather than pressed harder. Do not worship the headline. Read acceptance. Trade confirmation. If silver closes above 80, holds the first pullback organically, and builds higher lows across multiple subsequent sessions, you respect the move. You participate with structure. You know your invalidation point before you enter. You know your add-in points before the tape gives them to you. You know exactly what the market needs to print for your thesis to remain valid. That is not excitement. That is precision. If silver rejects the level, fails the reclaim attempt, and begins spending most of its time below 80 again, you step back. You do not force it. You do not average into a failing trade because being wrong feels unacceptable. You wait for the market to provide the next set of evidence, and you update your read accordingly. There is always another trade. There is no move that you absolutely had to be in at one specific moment, or your career is over. The traders who believe there is, the traders who act on that belief, are the ones who become the exit liquidity for everyone who waited for confirmation. Before I let you go, 2 questions, not for the algorithm, for you, because articulating your thinking out loud is the fastest way to discover whether your thinking is actually as clear as you believe it is. First, between the daily close above 80 and the behavior of the first pullback, which one do you personally treat as your decisive signal? Which one tells you more about what the market is actually doing, and why does that one carry more weight for you specifically? There is no universally correct answer, but knowing your own answer before the tape accelerates is the only way you will actually follow it when the pressure is at its highest. Rules decided under pressure bend. Rules decided in advance hold. Second, if you could watch only one of the 3 macro gauges I described, the dollar index, the 10-year yield, or real yields, which one would you choose, and how much weight would you give it relative to what the tape itself is showing you? Your answer to that question tells you something real about where your analytical framework is strongest and where there might be gaps worth addressing before this trade develops further. Put your answers in the comments. I read them. And the follow-up to this video, where I take every concept from today and apply it directly to the live tape structure developing in real time, session by session, is the video that everything you just learned is designed to set up. My name is John A.G. The tape is always printing truth. The only question is whether you are reading it clearly enough to act on what it is actually telling you, rather than on what you need it to tell you. I will see you in the next one. I will see you in the next